On today's episode, we are going to take a look at two growth stocks that are booming with the current market right now to see is it time to buy. For each stock, we're going to do a quick introduction. We're going to look at their earnings. We're going to look at some historical numbers, and we're going to also look at their future growth and valuations to see is it a buy for me right now. Like always, if you're new to the channel, make sure to subscribe and don't forget to hit the like button. It helps the channel out so much. Remember, none of this should be taken as advice as I am not a professional. And let me know in the comments, what are some of your favorite growth stocks right now? And while you're down there, don't forget to join the Discord channel. It's free to anybody that wants to join. And make sure to click that Webull link. If you sign up and follow that link, we both could get a free stock. Sometimes maybe even two stocks. So make sure to follow that link and get the instructions. All right, so the first company we're going to take a look at is TWILIO. This is ticker TWLO. They just reported earnings today. Stock price right now is $296 after hours. They're down about 1.5%. Their market cap right now is about $44.7 billion. This is actually not counting that drop, but with a 1% drop, it's not going to move that much from there. Year-to-date returns for TWILIO right now are about 192%. So congratulations to all the longs that are holding. And it's actually down about 11-12% from its all-time high of the year. So quick information of what TWILIO does. So they pretty much create APIs to allow communications for companies to talk with their customers in different channels. For example, they can do voice, text, chat, video, email, and other applications like WhatsApp and other, I think Facebook chat as well. So a perfect example is, let's say when you order something from a store and you instantly get a text message, hey, your order has processed, your order has been shipped. This type of applications, not everyone uses TWILIO, but that's exactly what they do. A few things about TWILIO. Recently, they did acquire a company called Segment, and this was actually an all-stock deal, which I think was a pretty smart move for them. The reason I think it was a smart move is there has been a nice increase in their valuations. We see over 200% increase at its all-time highs. So it did an all-stock deal, and they bought this company called Segment. And this is a company that does customer data platform. And many people might be like, what's the point of them having this customer data platform? How are they gaining and how is it helping TWILIO? Those are the questions one should ask when an acquisition happens. The data platform, right, kind of collects information about the consumer, and actually with all this data that they're doing can help TWILIO tell their customers, hey, this is what your customers like to react. This is how they like to react. They like to communicate via text. They like to communicate via email. They like to communicate during these times of the hour. So now with that type of data that TWILIO has, they can help now the businesses that use TWILIO will have a lot more information on their customers, which I think is actually a pretty smart move for TWILIO to do this acquisition. Not only is it an acquisition that makes sense, it was an acquisition that was done with no cash involved. So let's take a look at their most recent quarter. This is third quarter of 2020, and like I mentioned, it ended today. So for quarter three, they had non-GAAP earnings per share of about 4 cents. So it is profitable in the non-GAAP terms, and this did beat by about 8 cents. GAAP earnings per share are negative 79 cents. So if we take a look at GAAP numbers, they are not profitable, and this missed by about 6 cents. Revenue for the quarter was $448 million. This is up 50%, almost 52% compared to the same time last year, and it beat expectation by about 40 million. Gross margins were 55 million, and this was a little bit lower compared to the overall consensus, which was around 56%. At the end of this quarter, they ended with 208,000 customers. It's growing dramatically. We're going to see in a bit how that growth is coming. They also give guidance for the upcoming quarter. They expect total revenue to be about 450 million to 455. This is unfortunately, it seems like a very small jump compared to this quarter, but this is going to be 37% gain compared to the same time last year. In a non-GAAP, they are still expected to be a loss. They're expecting earnings per share to be somewhere around negative 11 cents to negative 8 cents on a non-GAAP earnings. So this is even though this quarter they were non-GAAP profitable, next earnings they're expected not to be non-GAAP profitable, and this guidance is actually a little bit weaker than what was expected by the overall analysts. Analysts were expecting earnings per share for the upcoming quarters to be negative 4 cents. So now let's take a look at this revenue growth over the past quarters for TWILIO. So it is pretty impressive how every quarter is gone a lot stronger than the quarter before. So it is, to me, one of the red flags is this upcoming quarter. This upcoming quarter will only be somewhere between 450 and 455. So there's not going to be much of a big change, right? We can see it right here where I'm going to be pointing this, right? So there's been huge increases over the past quarters. But with the new guidance, it'll be pretty much almost a flat line compared to the previous quarter. So that's something investors should definitely keep an eye on. Another thing I just want to mention that they talked about in their most recent earnings, where this quarter they did do a Class A offering. So one thing we're going to see is they do a lot of dilution in the past few years. They did at a stock price of $247. That's actually pretty cheap compared to where the stock is right now. Right now it's sitting at $298. And this was to raise about $1.4 billion. So they wanted to increase their overall cash position. So let's take a quick look at the company's income statement. So we can see revenue, it has increased dramatically compared to same time last year, right? In same time last year, they made about $300 million in revenue. This year, they made 450. So an increase of about $150 million. And the reason we can see, right, they still have loss from operations that we're looking at right here, but their losses hasn't increased that much. So even though revenue increased by 150 million, losses only increased by about 19 million. So eventually what's going to happen is they're going to grow their revenues enough to really offset this loss. And it seems like they're kind of getting to that point if their loss from operations is not increasing dramatically. Another thing is, like I mentioned, they are doing strong dilution numbers. Same time last year, they had about 136 million shares. Now they're sitting at 147 million shares. So that's not something I like to see, and something I just wanted to point out. Next, let's take a quick look at their balance sheet. As of assets, quick cash right now is about $3.3 billion if we add cash and cash equivalents, plus that short-term marketable securities. This is compared to about $1.8 billion that they had a year ago. So we see a nice increase of cash, almost what is that, about $1.5 billion of quick cash. Total assets increased by about $1.6 billion compared to the beginning of the year. So we can see most of that actually came from that quick cash. If we take a look at their total liabilities only increased by $100 million. So we're seeing a big increase in cash, about $1.6 billion in total assets increase, but only $100 million in liabilities. That's definitely a great thing. This company right now has a very, very strong balance sheet. It definitely has enough cash, just cash and cash equivalents, to pay off any debt, to pretty much pay off its total liabilities. So it has a very strong balance sheet, if I may say. But we are seeing that this huge increase in cash was mainly due to that dilution that we saw, about $1.4 billion. Next, I just want to take a quick look at their cash flow from operations. We can see here net cash flow provided by operating activities has increased a little bit compared to the same time last year. So we're seeing growth there. Again, it's not bad, right? For a company can raise cash in multiple ways. It can raise via debt or via new equity. They decide to go the new equity way. The new equity way is definitely smart, especially right now that their stock prices are at crazy levels. So it's not necessarily a negative thing, but it's just something one should understand is happening, right? So this company does get a lot of net cash from financing activities, and that usually comes from public offerings. So next, we can see TWILIO is expected to be a big growth company of 22.7% average annual growth for the next 3 to 5 years. Anything growing over 15%, I think it's considered a high growth. So this is doing 22.7. Unfortunately, if we take a look at non-GAAP on GAAP earnings, this is not expected to be profitable until the end of 2023. I also wanted to take a look at some of their past historical numbers to see how things are improving. The first thing I'm seeing is they have great margins, right? Gross margins of about high 50%, is maybe about 55%. But what I'm not too much of a fan is this negative profit margins, right? They are, if we take a look at GAAP earnings per share, profit margins are pretty weak. but we did see that this company had plenty of cash. So when the company has, if a company is not profitable right now, I tend to be a lot stricter on their balance sheet, and we saw they had a very, very strong balance sheet. I also wanted to take a look at past growth for revenue. In 2019, TWILIO grew its revenue 74%. In 2018, it was about 60%. And in 2017, it was a little bit over 40%. So it's definitely a huge growth company in both the past, and is expected to continue to be a heavy growth company in the future. So I also wanted to take a quick look at their cash flow margins. Operating cash flow margins are improving over time, but they are pretty much volatile. They do have negative free cash flow margins right now, but again, we're seeing kind of an uptrend. That's to be expected as the company becomes more profitable, but at least operating cash flow margins are positive, and they tend to be positive for most of the time. Now let's take a quick look at their valuation. Right now, this is not a company you take a look at forward PE ratio, and I think that's something a lot of people don't seem to grasp. There's a proper time to use PE ratios. There's a proper time to use price to sales ratio. A forward PE ratio would make no sense using a valuation to consider the valuation of the company. For this one, it's definitely more reasonable to use a forward price to sales ratio. Forward price ratio with this drop is probably now closer to 20 for the end of 2021. This is definitely not horrible with the overall way the market is valued right now. It's pretty much in line with what other companies are seeing right now. So right now, for me, TWILIO is definitely in a position where it's not bad to either start a small entry position or to add a small position to a position one already has, just to increase overall exposure. And for me, TWILIO, I don't know if you guys follow my tier ratings, TWILIO is one that I would put in my tier 2, or it's definitely a tier 3 stock for me, or it can actually be a tier 2 stock. I don't think I can ever see it as a tier 1. And with TWILIO having a market cap of about $44 billion right now, in the market it's in the type of way the overall technology is moving, I do see this as being a potential 2-3 bagger in the upcoming 3 to 5 years. The second company we're going to take a look at is CHEGG. This is ticker CHGG to all my podcast listeners. Right now sitting at $82.70 after hours after reporting earnings. This is down about 4 to 5%. Market cap right now is probably closer to $10 billion after that decrease in valuation after hours. Year-to-date returns are 115%. So again, congratulations to all you long-term holders. It's definitely been a crazy ride for CHEGG. It is down about 4% from its all-time high of the year, so it's not too far behind. So let's take a quick look at what CHEGG does. So CHEGG has two products. The first product is their CHEGG services. Here it's pretty much like a subscription base where you get like CHEGG Study, CHEGG Writing, CHEGG Math Solvers, and CHEGG Tutors. Then they have required materials. This is their second product, and this is when they rent or sell textbooks or ebooks. We're going to see the biggest portion of this company's revenue comes from the CHEGG services. They get a small portion from required materials. So let's take a quick look at their quarter 3 highlights. So quarter 3 non-GAAP earnings per share were 17 cents. This actually beat expectation by about 7 cents. So very similar to TWILIO. This is a profitable when we're taking a look at non-GAAP, but it's not profitable when we look at GAAP earnings. GAAP earnings were negative 29 cents for the quarter, and it missed by 9 cents. Revenue this quarter was $154 million, and that's up 64% compared to same time last year. Their CHEGG services, which what I mentioned was this portion right here, grew to 3.7 million subscribers, and is up 69% compared to same time last year. They also gave us guidance for this upcoming quarter. So for quarter 4 of 2020, they're seeing revenue of 188 million to 190 million. This is a big jump compared to quarter 3. They're seeing CHEGG services revenue to be 162 million to 164 million out of that 188 million. And we can see this quarter it was 119 million dollars came from CHEGG services. The rest came from textbooks. Gross margins are expected to be somewhere between 72-73%, where gross margins this quarter were 60%. Adjusted earnings before all those expenses are expected to be 82 million to 84 million. So we can see They're also giving a full year guidance for 2020, and that's obviously to be expected now that they finished Q3 and they only have 1 quarter left. It's very easy for them to kind of give guidance. So for total revenue, they expect to be $626 million of revenue. Out of that 626, about 507 coming from CHEGG services. They expect gross margins 68 to 69%, and adjusted earnings before all that to be 201 million to 203 million. They actually also give guidance for the upcoming year of 2021. Total revenue 775 million. They're seeing about 29% year-over-year growth. This is still a crazy growth company. Gross margins of about 70%. That's kind of what we're seeing with the company right now. Adjusted earnings to be 260 million, a lot better than what they're giving for 2020. So all these numbers are better than what they expect for 2020, and that's what should happen, right? You're supposed to be growing as the years progress. So now I wanted to take a quick look at their balance sheet. So they have seen a huge increase of cash of about $500 million compared to the beginning of the year. They also see a long-term investment increase by about $200 million. So total assets increased by about $800 million compared to the beginning of the year. Most of it coming from that jump in cash and cash equivalents, and some of it coming from that long-term investment. Now, if we take a look at their total liabilities have increased by about 700 million. So that's not something I like to see. Their total assets are increasing by almost a 1-to-1 ratio. But most of it is actually coming from convertible senior notes. So like we took a look at TWILIO, right? TWILIO decided to raise cash by offering new shares. CHEGG is also raising cash, but they're doing it in a different way. They're using senior notes. So this is a form of debt. This is a form of loan that they're doing. And that actually increased by about 600 million compared to the beginning of the year. This is the main reason they have increased that cash position. They do have an increase of deferred revenue, and this is actually, even though it's in the liabilities, it's a great thing to see, mainly in a company that does subscription. It means that subscription is increasing over time. That's definitely a good thing to see with that deferred revenue going up. Next, I wanted to take a quick look at their cash flow statement. Net cash flow provided by operating activities increased almost double compared to the same time last year. Like I mentioned, they are seeing, very similar to TWILIO, they are seeing huge cash coming in from net cash provided by financing activities, except they don't do it as offerings, they do it more as senior notes. And right here, I'm just showing you guys, this first 9 months of 2020, they did about $984 million through senior notes. Same time last year, they did about 780 million. So this is something they do very often, it seems. Now I want to take a look at their past numbers. Let's take a look at gross margins. Gross margins for this company is actually pretty impressive, sitting over 70%, almost close to 70%. That's something I'm very excited to see. They are almost gap profitable. We can see they are almost reaching that gap profitability to be a turnaround story for CHEGG in the upcoming future. In the past, they have seen crazy growth. We can see in this, they grew about 63% this quarter. The last quarter, they grew over 60%. The quarter before that, they grew about 30%. And the quarter before that, they grew its revenue about 30% compared to the same time last year. This has definitely been a crazy growth stock in the past 4 quarters. Now, they are also expected to continue that growth. They are a big growth company, expecting 17.3% average annual growth for the next 3 to 5 years. Like I mentioned, anything growing over 15%, I believe, is considered a very high growth stock. They are also expected to be profitable, gap profitable, by the end of this year. And that's something I'm very excited to see. Here in the past few years, a quick look at their cash flow margins. Operating cash flow margins are increasing. Great news. Free cash flow margins are positive and increasing. Now let's take a quick look at their valuation. Again, this is not one I want to look at forward PE ratio, because look at this. Forward PE ratios are decreasing dramatically over the years. So that means that this company is expected to be profitable and increase those earnings fast. Again, I'm going to look more at the price to sales ratio. Price to sales ratio for 2021 is 14.2. It might be closer to 14 now with the drop. This is actually pretty good, in my opinion, for a company that has a very high gross margins. We saw 70%. That's something we normally see in software stocks. And it's also expected to be profitable. Unfortunately, it's not as fast grower as TWLO, so I do believe that's a major reason why this is dropping a bit. It has a lower forward price to sales ratio because it doesn't have that similar. It doesn't have that similar type of growth that TWLO is seeing. And TWLO also has a better balance sheet, in my opinion. But this one already has operating cash flow margins that are positive and free cash flow margins that are positive. So it doesn't need to have that strong of a balance sheet like one that has negative, that has those margins negative. So TWLO, CHEGG, I would put it very similar to TWLO. CHEGG to me would probably only be a tier 3 stock. It's just not a market I'm too excited to own, but I do believe it's a position that can beat overall market. So I would put it in tier 3 stock. And these tiers don't mean much except just the position size that they would be in my portfolio. They all are companies that I believe will beat the overall market. So CHEGG would be one that, again, wouldn't mind starting a small position or wouldn't mind adding small position to it to increase my overall exposure. So I hope you guys enjoyed today's episode. Like always, if you do, make sure to hit the thumbs up. It helps the channel out so much. And let me know in the comments, did you guys like any of them? If so, which one did you prefer?